Hello, hello. Hi guys, good morning. How are you all? Welcome back. Good morning, Pooja. Good morning, Arya. Good morning, Riza. Okay, so let's continue with Indas 33. Let's continue with Indas 33. Anila, good morning. Sharad, good morning. I have given you one homework. The homework was illustration number 8 and illustration number 9. Good morning, Mohammad Nawaz. So homework was illustration number 8 and illustration number 9. Okay. First of all, guys, for today only, please switch to Telegram group for chat. Please guys, for today only, please switch to Telegram group. Our Telegram group, that is CA Final Crash 2021 FR. All the chats will be done on that Telegram group for today only, please. So please do not chat on our video player software. Please switch to Telegram group. Guys, please switch to Telegram group for chat. All the students, all the live students, please do chat on Telegram group only for today. Okay. So illustration number 8 and 9, illustration number 8 and 9 were the homework, right? Okay, great. Arya is there, Sharad, Pooja, Riza, Anila. Okay, great. Okay. So what about the homework points? What about the homework? Illustration number 8 and illustration number 9. Homework done. Homework done, sir. Sharad, done. Nawaz, done. So can I say that yes, illustration number 8 is done. Illustration number 9 is done. Don't you have any doubt? Don't you have any doubt? Please tell. Okay. Okay. Now come to the third point. Come to third point, that is compulsory convertible debentures or preference shares. Compulsory convertible debentures or preference shares. Compulsory convertible debentures or preference shares. What about this? See, when we issue such kind of instruments means compulsory, mandatory convertible shares, convertible debentures or mandatory convertible preference shares. That means what? From very first day of issue of those debentures or preference shares, we know that at the time of redemption, no cash outflow will be there. We know that at the time of redemption, we are going to convert all these instruments into various number of shares or number of equity shares. So from very first day, from very inception, like from very first day of issue of these kind of instruments, we know that the shares, the equity shares will be issued after some period of time, like after a particular span of time. After a particular span of time, the shares will be issued and they are definitely going to be issued. These are convertible debentures. So India says, when we know that after 3 years, 5 years, 10 years, equity shares will definitely be issued, it is definitely clear that we are going to issue the equity shares. Then what to do? Mandatory or compulsory convertible instruments convertible into equity are to be considered while calculating basic earning per share. That is, number of promised shares on conversion of those instruments shall be considered in the calculation of weighted average number of shares. From the date of contract, that is from the date of issue of such instrument. That means, let us say this is the date 1st April 2019. We issued convertible debentures. ठीक है ना? These are mandatory or compulsory. Mandatory convertible. And we know that they are going to redeem, they are going to convert on 31st of March 2027. They are going to be converted on 37th March 2027. This is the future date. So from today onwards, consider them as equity only. Consider them as equity only. From today only means from 1st April 19 onwards, you have to consider them as equity share only. You have to consider them as equity share only. Understood? Guys, understood or not? However, interest paid on such instruments shall be treated in a normal way and deducted from the net profit. Although, whatever the interest you are paying every year, whatever the interest you are paying every year, you have to consider, you have to consider such interest for calculating the net profit or loss. For calculating the net profit or loss, you have to consider such interest, such net profit. Understood? Simple. Like interest will be regularly deducted while calculating the profit or loss attributable for equity shareholders. Like interest will be regularly deducted every year while calculating the numerator, the earning available for equity shareholders. In absence of any specific information, always assume that convertible instruments are not mandatory. Okay, not mandatory, not mandatory, but optional. Optional convertible shares or instruments are not considered in calculation of basic earning per share, but to be considered in diluted. Suppose if in the question the information is missing, like the question gives you some convertible instruments, convertible debentures or convertible preference shares. What will you do? Are these mandatory or optional? You will always assume that these are not mandatory, these are optionally convertible. Like the holder must have the option whether to convert such instruments at the time of redemption into equity or to ask for the money, to ask for the cash. So in absence of any information, we cannot assume, or we should assume that these are optionally convertible instruments. These are not mandatory. Understood? So this is the simple point on that. Please guys, I am giving you 2 to 3 minutes. Please try this illustration number 10. Please try this illustration number 10. Please try this illustration number 10. Guys, everyone, you need to try, you need to attempt this question right now. Illustration number 10. Please attempt this. Outstanding equity shares on 1st April 18, 1 lakh numbers of rupees 10. Issued 9% compulsory convertible debentures. Compulsory convertible debentures on 1/7/18. 10,000 numbers. Convertible after 3 years in the ratio of 3:1. Convertible after 3 years in the ratio of 3:1. EBIT 12 lakh, tax expense 180. Okay. Please solve it, guys. $7.78. 7.78. Arya said 7.78. How come, dear? Okay, tell me the solution. EBIT 12 lakh minus interest. So interest will be calculated for 9 months, na? Because the debentures were issued on 1st of July 2018. So interest will be calculated on 10,000 into 100, right, into 9%, into 9 divided by 12. So interest would be calculated for 9 months. Interest would be calculated for 9 months, right? 67,500 minus tax, that is 180. So 12 lakh minus 67,500 minus 180. So 952,500. 952,500 is the numerator, right? 952,500 is the numerator. Now what about denominator? Weighted average number of equity outstanding. 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 So it will be 1 lakh. 1 lakh are the number of shares into 12 by 12 plus see, 10,000 are the number of debentures, but they are going to be converted into 3:1. So 30,000 equity shares will be there. Since these were issued on 1st of July, so we have to give the time wait for 9 months. We have to give the time wait for 9 months. So it will be 122,500. Weighted average will be 122,500. Right? So finally the basic earning per share would be 952,500 divided by 122,500. It's 7.78 per share. It's 7.78 per share. It's 7.78 per share. Understood, guys? Okay. So this was compulsory convertible debentures or preference shares, right? Okay. Okay, now come to this right issue part. Leave this one for the time being. Shares issued under business combination. Leave this part for the time being. We'll discuss it after some time. First of all, come to this part, right issue of shares. Right issue. It is important. Come to this part, right issue of shares. Right issue of shares. Okay. Guys, what do you mean by right issue? Right issue means issuing the shares or giving the right to the existing shareholders. When a company proposes to issue the shares or propose to further issue the shares, the company has to give right to the existing shareholders to purchase the shares, right? So right issue means giving right or giving advantage to the existing shareholders for purchasing the shares. Even the right issue, when we give the right or when we offer the right issue to the existing shareholders, we can offer the right issue at some discounted price. We can offer the right issue at some discounted price, right? Clear? Now, suppose if the company is going to issue the shares, if the market price of the share, let us say the market price of the share is 90 rupees. What's that? 90 rupees. Suppose the market price of the share is 90 rupees. And company proposes to issue the right shares to its existing shareholders at 75 rupees. That may be the case. At 75 rupees. Understood? So 90 rupees is the market price of the share and 75 rupees is the right issue price of the share. 75 rupees is the right issue price of the share. Understood? Now, in this overall right issue topic, we have to understand that there's a bonus element. We have to understand that there is a bonus element. How the bonus element is there? Since we are issuing the shares at a discounted price, that is 75, we should issue the shares at 90. Technically, we are giving 15 rupees discount to the existing shareholders. So, this overall right issue part must include some bonus part. And we already know in our last session, we already know that the bonus part, that on the bonus numbers, we always provide time weight from beginning of earliest presented period. As far as bonus is concerned, bonus is always considered from the beginning of earliest period presented. You remember? That means we always give 12 by 12 time weight for the current year as well as for the previous year in case of bonus issue. Understood or not? So basically, to solve the questions regarding right issue, what we need to do? We need to understand that how much portion is in respect of bonus issue, right? Okay. Now, before discussing the formula for right issue or before discussing how to calculate the EPS in case of right issue, we should first discuss some terminology in respect of right issue. In respect of right issue, there is one price called right issue price. There is one price called right issue price. Now, right issue price, the price or discounted price at which equity shares are offered for issue. This is our right issue price. Okay, this is our right issue price. This is our right issue price. This is our right issue price. Now there is one come right market price. Come right market price of the share. Come right market price of share. Come right market price of the share. Basically, this is the market price including right issue or including right advantage. Including right advantage. What is this come right price or come right market price including right issue advantage means? Suppose I announced, when the company announced right issue for the shareholders, suppose when the company announced right issue for its shareholders, those who are not actually the shareholders may want to purchase the company shares now so that they will become the existing shareholders and so that they must get the right. Let us assume that today on 20th September, I announced that in future I am going to give you the right issue. In future I am going to give you the right issue. Let us assume that today on 20th September, company announced that in the month of October, mid-October, so like 15th October, company will issue right shares to its existing shareholders. And for this purpose, company says that for this purpose, we will consider 1st October as a record date. Now, what do you mean by record date? Anybody? Anybody? Do you know the concept of record date? Do you know the concept of record date? Anybody, please? Anybody, please tell me. Do you know the concept of record date? Do you know the concept of record date? On 20th September, company announced right issue and company will give right issue, company will issue the right shares on 15th October. For this purpose, the record date will be 1st October. Very good, Akash. Very good, Akash. Holding shares on record date makes eligible for right issue. Company announced that record date for the purpose of right issue will be 1st October. That means on 1st October, whoever will be the member of the company will get the right issue. Whoever, any person who is the member of the company as on record date will get the right issue. Will get the right issue advantage. Will get the right issue advantage. Akash has rightly said that definitely Akash is correct. On 1st October, whoever will be the member whose name is included in the register of members will be eligible for right issue. Will be eligible for right issue. Will be eligible for right issue. Now come back to our example. On 20th September, company announced right issue. The right shares will be actually issued on 15th October, that is in future. For this purpose, the record date will be 1st October. So now the public, we all have, those who are not holding the shares of the company, we have 10 days. That in such 10 days, if we become the member of the member of this company, we will be eligible for the right issue. So what happened? As soon as company announced the right issue on 20th September, the share price shoot up. The share price actually, the share price shoot up. Understood or not? The share price increased temporarily. The share price increased temporarily. Understood or not? For a temporary time, for a temporary period, the share price increased. Why? Because of demand and supply concept. any person who is not the shareholder of the company on 20th September will try to buy the share so that his name should be included in the register of members as on 1st October. And when his name will be included, he or she will be eligible. He or she will be eligible to get the shares. Understood or not? And those who are already the shareholders of the company, they are not going to sell their shares because they are the members. They are not going to eligible. So basically, because of demand and supply concept, for a temporary period, the market price of the company shoot up. Guys, I hope you are understanding this concept. So, come right price of the share means the market price inclusive of right advantage. Now anybody want to purchase the share even at a higher price because they know that by paying higher price they are going to get the right advantage. So the market price of the share including right advantage. So suppose the share price becomes 98 rupees. 98 rupees is the come right price. That means anybody actually wants to purchase the share, and they are actually paying higher value because they know that by paying the higher value they will get the right advantage. They will get the right issue advantage. Understood or not? They will get the right issue advantage. So let us assume that 98 is the come right price. Guys, have you understood this concept? Have you understood this concept? Okay. Next. Now there is one X right market price of share. X right market price of share. What is this X right market price of the share? When come right market price of the share includes right issue advantage, the X right market price of the share does not include any right advantage. X right market price of the share is a genuine market price without any advantage. It is the genuine market price. Genuine market price means the market price which does not including any right advantage. So we can say it is a genuine market price of share without any right advantage. Genuine market price of the share. Definitely it may be less than come right price. It may be less than come right price. Okay. Now please try to understand that this price will always be given in the question. Will always be given. In the question. This price will always be given in the question. This price will always be given in the question. Will always be given in the question. But this price we need to calculate. This price. We need to calculate this price. Now, how to calculate this price? How to calculate this price? This is also known as theoretical X right price, also known as theoretical ex-right price. Theoretical ex-right price. Now, how to calculate this? The formula is total outstanding shares before right issue, total outstanding shares before right issue, total outstanding shares before right issue multiplied by cum right price multiplied by cum right price multiplied by cum right price. ठीक है, right issue price multiplied by number of right issue whole divided by total outstanding numbers after right issue. Total outstanding numbers after right issue. This is the formula we have. X right price without any right advantage. X right price without any right advantage, right? Without any right advantage. Okay. Now let's discuss the question, how to solve the questions of right issue, how to calculate the EPS in case of right issue, how to calculate the EPS in case of right issue. Let's discuss. Illustration number 13. At 31st of December 11, the issued capital of the company consisted of 1.8 million ordinary shares. 1.8 million means 18 lakhs ordinary shares of 10 each. The profit for the year ended 31st December 11 and 12 rupees 630 and rupees 875, 8.75 lakh. Okay, they have given the profits for the 2 years. So for the last year it was 630 and for the current year it is 875. Okay. On 31st March 2012, the company made a right issue on a 1-for-4 basis at rupees 30. At rupees 30. Now what is this 30? 30 is the right issue price. 30 is the right issue price. The market price of the shares immediately before the right issue is 60. Now what is 60? 60 is come right price. It is given in the question. Now we offered right issue at 30. 30 is the right issue price. Just immediately before right issue, the share price was 60. 60 is the come right price. Now they are asking us to calculate EPS, to calculate the EPS. So our first step will always be to calculate the X right price. Now I am giving you 2 minutes to please calculate the X right price of the share. The X right price of the share. Please try to find out the X right price of the share. Okay, what's the answer? C. Solution. 13th illustration. Okay. Our step number 1 would be to calculate X right price. Calculate X right price. Like number of shares outstanding before right issue. Number of shares outstanding before right issue was 18 lakhs into come right price, that is 60 rupees, plus number of right issue shares, 1 for every 4, so 18 lakh divided by 4, that means 4,50,000 numbers into right issue price, that is 30, divided by 450 plus 18 lakh, it's 22,50,000. So 18 into 60, 450 into 30 divided by 2250, it's 54. It's 54. Very good, Sharad and Pooja. It's 54. 54 is the X right price. Our step number will always be to calculate X right price. Understood? To always calculate X right price always. Okay. Now step 2. Step 2. Calculate weighted average outstanding equity. Calculate weighted average outstanding equity. Calculate weighted average outstanding equity. Now for this purpose we have, frankly speaking, we have two alternatives to find out the weighted average equity. Guys, we have two alternatives. So let us start with alternative number 1. Alternative number 1. We have two ways to calculate the weighted average. In both the alternatives, our answer would be same. The final figure would be same. Okay. So we have two ways. First alternative, how to calculate the weighted average. How to calculate the weighted average portion. First alternative says find out bonus part and paid part of shares from right issue. Now what is this paid part and bonus part? What is this paid part and bonus part? Find out bonus part and paid part of shares from right issue. How? Actual funds raised from right issue, actual funds raised from right issue, actual funds raised from right issue, actual funds raised from right issue. Right issue was at 30 rupees and number of shares were 450. So 450 into 30. It's 1 crore 35 lakh. It's 1 crore 35 lakh. It's 1 crore 35 lakh. Okay. It's 1 crore 35 lakh. Understood? One crore 35 lakh. Now, if the same funds would have been raised from general public at X right price, if same funds would have been raised from general public at X right price, what would be the number of shares to be issued? Same funds like 1 crore 35 lakh. if the same funds would have been raised from general public at X right price. Now X right price is the genuine price, na? X right price is what? It is the genuine market price of the share. So our X right price is 54. If the same funds would have been raised at a 54 rupees, if the same funds would have been raised at 54 rupees, what would be the number of issue? The number of shares to be issued were 2,50,000. The number of shares that could be issued, 2,50,000 numbers. Now compare. We actually issued 450 by way of right issue and raised the funds 1 crore 35 lakh. The same funds would have been raised by issuing the shares at 54 at only 2,50,000 numbers. So technically, out of 4,50,000 number of right issue, for 250 shares, we are actually getting the money. For rest 2 lakh shares, we are not getting the money. Again. Actually, we issued 4,50,000 numbers. Actually, we issued 4,50,000 numbers. Guys, understood or not? Actually, we issued 4,50,000 numbers. Out of this 4,50,000 numbers, as far as 250 is concerned, we have actually raised the amount. We have actually raised the amount for 2,50,000 numbers. Rest 2 lakh is actually the bonus part. Because if the same funds would have been raised at 54, only 2,50,000 numbers could have been issued. So out of 450 numbers, 250 are in respect of the amount which we raised, and the rest 2 lakh numbers are actually the bonus, are actually the free of the shares issued at free of cost. The shares issued at free of cost. So technically, we can say that out of total actual right issue of 450, total actual right issue of 450, 250 numbers is a paid part and 2 lakh numbers is bonus part. Have you understood this concept? That means we could have raised 1 crore 35 lakh by issuing just 2,50,000 shares. So what is the need of issuing extra 2 lakh shares? We issued overall 450 to our existing shareholders, not at 54 rupees but at 60 rupees. So this is the reason why we issued them extra shares. Technically, these 2 lakh shares are the extra shares we issued to our shareholders, to our existing shareholders at free of cost. We could have raised 1 crore 35 lakhs at 54 only by issuing 2,50,000 numbers only, but we actually issued 450. So definitely the 2 lakh shares are issued. The 2 lakh shares are issued. The 2 lakh shares are issued at free of cost. Understood? The 2 lakh shares are issued at free of cost. So this is the bonus element and this is the paid part. Paid part means as good as a normal public issue, as good as a normal public issue, as good as a normal public issue. We are doing alternative number 1. So now to calculate the weighted average, see this. To calculate the weighted average, see this. Guys, if I am not wrong, our current year is, in this question our current year is, okay, our current year is 2012. So on 1st January 2012, on 1st January 2012, we were having outstanding 18 lakh into 12 by 12, 18 lakh plus on 31st March, right? The date was 31st March, na? 31st March 2012, the company made a right issue. So on 31st March 2012, there was a right issue. On such right issue, there is one paid part and there is one bonus part. There is one paid part, there is one bonus part. As far as paid part is concerned, these are 2,50,000 numbers, and we issued on 31st March, that means 9 by 12, because it is a calendar year. Guys, remember, this is a calendar year. As far as the bonus part is concerned, we always take bonus from the very inception of current year, or even from the outstanding from the beginning of earliest period presented. That means 12 by 12. $187,500 and 2 lakh. So finally we got 187,500, 2 lakh. Finally we got 21,87,500. This is weighted average outstanding numbers. This is weighted average outstanding numbers. Weighted average outstanding numbers. Weighted average outstanding numbers. Now tell me guys, now tell me, have you understood? This is weighted average outstanding numbers. Now as far as EPS is concerned, this was, see, this was the first alternative, right? This was the first alternative. This was the first alternative. This was the first alternative. Now as far as the second alternative is concerned, alternative number 2. As far as second alternative is concerned, second alternative, calculate right factor or adjustment factor. adjustment factor. Now what is this right factor or adjustment factor? The right factor will be, come right price divided by X right price. Come right price divided by X right price. That means 60 divided by 54. 60 divided by 54. Now how to calculate weighted average outstanding equity? To calculate weighted average outstanding equity, please come here. Remember that current year is 2012. Remember that current year is 2012, right? On 1st of January 2012, the opening balance was 18 lakhs. The opening balance was 18 lakh. January, February, March. Till March, it was 18 lakh. It was 18 lakh. 80 multiplied by right factor into 3 by 12. Why 3 by 12? 3 by 12, like it's like the cumulative time weight. You remember, time weight can be done by both alternatives. Cumulative time weight. There is one individual time weight or there is cumulative time weight. Now we multiplied this 18 lakh by right factor. Now why we multiplied this 18 lakh by time factor? Since, see, we are basically 18 lakh, for 18 lakh we are making this as equivalent to right issue. Okay, now on 31st March 2012, it was a right issue. It was a right issue. 31st March, it was a right issue. And after right issue, total shares become 22,50,000. After right issue, total shares become 2250, like 18 plus 4.5. And this will be for rest 9 months. This will be for the rest 9 months. Okay, now please make the calculation. 18 lakh into 60 divided by 54 into 3 divided by 12. 5 lakh. 2250 into 9 divided by 12. It is 1687,500. The total is 2187,500. If you can see, her alternate answer was also same, 2187,500, and it is under alternative 2, 2187,500. Now why we have multiplied 60 divided by 54? Technically, see this, the concept is, this is January 2012, this is April when we made a right issue. For this period, the share price was 60 rupees. But originally it should be 54. So what we are doing? 18 lakh was based on 60. What if the shares are based on, what if the share should be based on 54? So 18 into 60, since it was actually based on 60, what if it would be based on 54? Understood? Okay, so please write the alternative number 2. Okay. So this was alternative number 1, this was alternative number 2. Now it's time to calculate step 3. Calculate basic earning per share. So what was the earning? Earning was 875 divided by 21, 87, 500. .4 per share. .4 per share. .4 per share. Basic earning per share of current year. One more, restated BEPS, restated BPS of previous year, restated BEPS of previous year, or we should call it as BEPS of previous year. इसमें first of all original BEPS, the earning was 630 based on 18 lakh numbers. It was 0.35 per share. Now restated, restated EPS, it should be 630 divided by 18 lakhs plus the bonus part, that is 2 lakh, plus bonus part, that is 2 lakh. .315 per share. .315 per share. Understood? .315 per share. Guys, any comment? Guys, any comment? I am not getting you. Any comment, guys? Any doubt? So this is your right issue. Okay, step number 1 to calculate X right price. Step number 2 to calculate weighted average with alternative number 1 and alternative number 2. Step number 3 finally to calculate the basic earning per share of the current year and restated basic earning per share of the last year. Do you have any questions on this? Do you have any question on this? No? Does alternative number 1 helps as to get bonus part for each? No, not like that. Even if you are not following alternative number 1, then also you can calculate the restated EPS with the help of alternative number 2 also. How? Or 630 divided by 18 lakhs into 60 by 54, 12 by 12. See this. You can calculate with the alternative number 2 also, guys. Just multiplied the right factor with the opening equity. Just multiply the right factor. When you multiply the right factor, the opening equity will be converted inclusive of bonus. Now it will be inclusive of bonus. Understood? It must be inclusive of bonus. Akash, cleared or not? Question number 2 of questionnaire will be your homework and that is based on right issue. Question number 2 of your questionnaire will be your homework. I will not at all discuss this question with you. Okay? Okay, you need to attempt this question right now. Try now. Question number 3. Just attempt this question right now. Please attempt this question right now. Current year basic earning per share 34.78. Previous year original 88.89. Restated 44.44. Okay, so Pooja has got the answer. Arya has got the answer. Two students are only getting the answer. So what about others? Others are not. What is the concern basically of yours? Others are not deliberately applying, replying, or what? Matlab, you guys are having doubt, or you got the answer but you are not in a mood to reply. What about others? I just wanted to know. What about others? You guys got the answer, you guys got the correct answer, but not replying, just like why to reply? Or you didn't get the answer. Hello? Okay, shall I discuss this, or since Pooja, Arya and Sharad has replied with the correct answer, then I should assume that yes, okay, it will be fine with other students also. You guys are not replying. It's really frustrating sometimes. It is really frustrating sometimes. Not getting your reply now, it's like, why? What the hell is going on in your mind? Why you guys are not replying? I can't understood actually. I actually can't understood sometimes. Question 3 is done. 2 years earnings are given, 10 lakhs and 12 lakhs. Earning attributable to equity, okay, equity shares, 10,000 shares of fair face value 10, 5,000, 3,000 equity shares on this and this respectively, shares fully subscribed, paid up, 1:1 bonus on 112.5. So yes, if you haven't tried it, it will be your homework. For all those students who are not with me right now, who are not watching the lectures on live, if they are watching the lectures after some days, or they are watching the lectures on offline, they can ask me the doubts if they have. Okay. Question 4 will be the homework. It is of right issue again. So question number 2 and question number 4 will be the homework. Question number 2 and question number 4 will be homework. Okay, so this was a right issue of shares. Now after right issue, we have diluted per share, diluted earnings per share. After right issue, we have diluted earnings per share. But before it, let's discuss this small part. Shares issued under bonus business combination. Sorry, business combination. Shares issued under business combination. Let's understand this part. Shares issued under a business combination. What do you mean by business combination? Business combination means mergers, acquisitions, takeover, like that. Under business combination, there are two parties, acquirer and one is acquiree. One is acquirer and the another is acquiree. Acquirer takes over the control over the business of acquiree. Okay. Now, what will be the impact on EPS due to business combination? What will be the impact on EPS due to business combination? So let's read it. Equity shares issued as a part of the consideration under business combination shall be considered from acquisition date of business while calculating weighted average number of shares. It is very, very simple. For example, let us say I am the acquirer company. I am the acquirer company. What I did, I acquired the business of acquiree. I acquired the business of another company. Let us say I acquired the business. I acquired the control over the business of another company on 1st August. So 1st August will be the date of acquisition. 1st August will be considered as date of acquisition. Once again, the date on which acquirer obtains the control over the business of acquiree will be treated as date of acquisition, right? Now, what acquirer got? Acquirer got the business. Acquirer got the control. And against getting the control, acquirer pays consideration. Acquirer pays consideration. Guys, understood or not? Against getting the control, acquirer pays consideration to the shareholders of acquiree. Now, the consideration may be paid in the form of equity shares. The consideration may be paid in the form of equity shares, guys. Understood? So, acquirer may issue the equity shares during the year. Acquirer may issue the equity shares during the year to the new shareholders, like to the shareholders of acquiree, since acquirer taken over the business of acquiree. Okay. So, these new equity shares will be considered for the purpose of basic earning per share working or earning per share working, and the time weight will be given from date of acquisition. The weighted average will be taken from date of acquisition. Guys, understood or not? Why from date of acquisition? Since on date of acquisition we got the control, from date of acquisition we will start consolidating the income of acquiree with our income. We start consolidating the expense of acquiree with our expenses. We start consolidating the entire earnings with our earnings from the date of acquisition. Okay. Acquisition date means the contract date, that is the date on which net assets, NCI, consideration, goodwill are first measured. Now please come to this question, illustration number 11. Illustration number 11. On 30th June 2001, B Limited merged into A Limited. B Limited merged into A Limited. The following is the relevant information for the year ended 31st March 2002. 31st March 2002. On 30th June 2001, B Limited merged into A Limited. 30th June 2001, B Limited merged into A Limited. So 30th June 2001 becomes the date of acquisition, 30th June. Following is the relevant information for the year ending 31st March 2002. Okay, so our financial year is 1st April 1 to 31st March 2, and here is date of acquisition, DOA. DOA. On this date, B Limited merged with A Limited. Okay, now the net profit until acquisition 5 lakh. After acquisition, 2 year ending 8 lakh and 2 lakh. Number of shares at the start of the year 6,000. On the date of acquisition 6,000 and 4,000. At the end of the year 10,000. What will be the earning per share? See, we are calculating earning per share. This is the question, illustration 11. Calculation of basic earning per share for A Limited. SFS of A. SFS of A. Now, what is SFS of A? SFS means separate financial statements. Under separate financial statements, A will consider its own earnings. A will consider its own earnings, right? So, SFS of A is like 13 lakhs divided by 13 lakhs 13 lakhs divided by, is there any connection issue? $13 lakhs divided by number of shares. So how many number of shares are? 6,000 were in the beginning. So 12 by 12. And at the end it was 10,000. At the end it was 10,000. So 6,000 minus 10,000. So that means we issued extra 4,000 shares. We issued extra 4,000 shares. We issued extra 4,000 shares on the date of acquisition, so 9 by 12. So in the separate financial statements of A Limited, the earnings belongs to A company only, and the divided by total number of shares issued by A during the year. So 6,000 were already outstanding from the beginning, and in the mid of the year, 4,000 were newly issued as a part of the consideration. So it will be 144. The basic earning per share will be 144.44. Will be 144.44. But if the same basic earning per share would have been calculated for CFS of A, consolidated financial statements of A must consider the earnings of B now. So earnings of B will be 2 lakh after the acquisition. So it will be 15 lakhs divided by same 6,000 into 12 by 12 plus 4,000 into 9 by 12. It's 166.67. 166.67. So this is the thing. What is the difference between CFS and SFS earning per share? Under SFS earning per share, we took only the earnings earned by A Limited individually. But under CFS, we took earnings earned by A Limited, and after acquisition, the earnings of B Limited also. The earnings of B Limited also after acquisition. Simple. Since here in this question, it is nowhere written that A Limited, how much holding percentage A Limited is having. We are assuming that A Limited is having 100% holding in B Limited. 100% holding in B Limited, and that is the reason we took 100% of 2 lakh, 100% of the earnings of B Limited. Okay. Now please try this question, illustration number 12. Please try this question. Illustration number 12 is done. Pooja got the answer. Arya got the answer. illustration number 12 is done, right? Since some students are not active or actively participating, or they are not replying on my questions, so I have decided to not consider them as my student for this session. Or if this continues for the next sessions also, then I will definitely not at all consider their doubts. Now I will definitely not at all listen to them. I have decided this. Since some students are actually not replying to me properly, they are not actually concerned about their teacher. Like if they have any doubt, they would like to, they will definitely ask me. But if I'm asking that please do reply, they are not having any concern. They are not replying properly. So why should I continue with the same with the same student? So I have decided not to consider any doubt of those students. I'll not listen to them. Okay, so shares issued under business combination done. Right issue of shares done. Measurement compulsory, shares issued under business combination, right issue. All four parts are done. All four parts are done. The last one is diluted earning per share. The last one is diluted earning per share. The last one is diluted earning per share. Okay. So now this is the most important part, diluted earning per share. Let's have a break right now for 5 minutes. Let's have a break for just 5 minutes only. After 5 minutes, we'll continue with the same, that is diluted earning per share. As far as diluted earning per share, yes, the basic part will be covered. The diluted, non-diluted, okay. Call or put, okay, call issued, okay, not an issue. We'll be able to cover the basic part at least in this session. Okay, so for diluted earning per share, we'll start the session. After 5 minutes, I'm just taking a short break. Yes, welcome back after the break. Okay, shall we start, guys? Now the last point which is obviously the big one, it will take the next session also to cover up the entire portion. But yes, this is a very important part, diluted earnings per share, the last one. Till now we have understood basic earning per share working. How to calculate basic earning per share, till now we understood this. How to calculate basic earning per share. Now we are going to talk about diluted earning per share. Now what is this diluted earning per share? Why we calculate diluted earning per share? Why we calculate two different earnings per share? Okay. Why we calculate two different earnings per share? There is one basic earning per share and there is one diluted earning per share. There is one basic earning per share, there is one diluted earning per share. See, basic earning per share gives us actual current year information. Basic earning per share provides us the actual current information based on the current earnings of the company. But why we calculate diluted earning per share? By calculating diluted earning per share, we just want our shareholders to consider the future conversions. We just want our shareholders to think on prudence basis. Like we just wanted to convey to our shareholders that in future there are some instruments, there are some debentures, or there are some preference shares that they are going to, they may be converted in the future. They may be converted in the future in the form of equity shares. So considering their conversion, suppose if they would have been converted in the current year only, suppose there are some convertible instruments like debentures. Suppose there are convertible instruments like debenture. Now I just wanted to convey to my existing equity shareholders that okay, we have our basic earning per share, right? Okay, happy. Now suppose the same debentures, they will be redeemed after 5 years. They may or may not be converted into equity. But suppose if they would have been converted into equity in the current year only, suppose they would have been converted into equity in the current year only, what will be the impact on your basic earning per share? What will be the impact on your basic earning per share? Suppose we calculated basic earning per share of rupees 80 per share. Now this basic earning per share was calculated after considering interest on debenture. Like we calculated basic earning per share by considering the earnings and number of shares. So when we calculated the earnings, now the earnings were calculated after deducting interest on debentures. Okay. And when we calculated the denominator, we took the actual equity. So basically the formula of basic earning per share is earning attributable to equity shareholders divided by actual equity shares outstanding, weighted average. See, actual equity shares, right? Now I would like to convey to my shareholders that okay, we gave you 80 rupees per share earning based on current year working. Happy? But please consider one more thing, that we have outstanding convertible debentures that may be converted after 5 years. Halaki, although we have given them the option that on the date of redemption, if they want cash, then we have to pay them the cash. If they need equity shares on conversion, we will provide them equity shares. So I just want to convey to my equity shareholders that suppose if the same debentures would have been converted into equity in the current year only, what will be the impact on your basic earning per share? Your basic earning per share may be reduced or may not be reduced. If in the same current year, those instruments, those debentures, if they would have been converted in the current year only, what will be the impact in your basic earning per share? The basic earning per share may get reduced. The basic earning per share may be diluted, and such earning per share, after considering those instruments, will be called as diluted earning per share. Now see, what is the meaning of dilution? What is the meaning of dilution? Dilution means like when we combine two or more elements together, the impact of each and every element will be diluted, right? Dilution means reduction. Understood or not? The effect gets diluted. Okay. So please first of all read this. Please read this point, okay, and then we'll understood the points. Okay. Dilution is a reduction. Dilution is the reduction in earnings per share or an increase in the loss per share. When your basic earning per share gets reduced, why it will reduce? Because of some other instruments. Now those other instruments are known as potential equity shares. Potential equity shares. See, there are two kinds of equity shares. One, ordinary equity shares, which are actually the equity shares. We consider ordinary equity share in the working of basic earning per share. The next equity shares are potential equity shares. These are actually like convertible securities, like convertible debentures, convertible preference shares, ESOP. These are not actually the equity shares or shareholders right now. They may become equity shareholders in the future. They may become equity shareholders, equity shares in the future. So, why we calculate diluted earning per share? Suppose if the company has some potential equity shares. Suppose the company has some potential equity shares. If the company is not having any potential equity shares during the year, company will not calculate diluted earning per share, or you can say the diluted earning per share of the company will be equal to basic earning per share. Once again. Suppose the company is not having any kind of potential equity shares. Now, what do you mean by potential equity shares? Potential equity shares means those securities or those instruments, which may be converted into equity shares, which may become ordinary equity share in the future. So, if the company has some potential equity shares during the year, company has to calculate diluted earning per share separately. Why? Because considering those potential, although they may be converted in the future, but suppose if they would have been converted in the current year only, what will be the effect on our basic earning per share? The basic earning per share may get reduced. If so, that it means it is a diluted earning per share. So it is a reduction in earning per share or the increase in loss per share. The loss per share may be increased because of their conversion, resulting from the assumption that convertible instruments are converted, that options or warrants are exercised, or that ordinary shares are issued upon the satisfaction of certain conditions. Ultimately, because of the potential equity shares. So, because of the potential equity shares, if the same potential equity shares would have been the ordinary equity shares in the current year only, what will be the impact? Now, what is this anti-dilution? Anti-dilution is a reversal of dilution. Like dilution means reduction in basic earning per share. Anti-dilution means increase in the basic earning per share. Anti-dilution is increase. Like what would happen? What will happen if because of their conversion into equity, our basic earning per share will be increased. It will be called as anti-dilution. And Ind AS 33 says the anti-dilution should not be presented in the financial statements. If the result is dilution, you have to present it, you have to show it in your P&L. If the final result is anti-dilution, you can't show it. Because it is against prudence. Understood? Understood? Okay. A potential equity share is a financial instrument of other contract that entitles or may entitle its holders to convert its holding into equity shareholders. Potential equity share means any instrument under which holder has the entitlement or holder has the right to convert its holding, to convert its holding into equity share. Okay, it may be convertible debenture, convertible preference share, it may be ESOP, it may be like share warrants, it may be shares issuable, contingently issuable shares. Contingently issuable shares, you remember we discussed this topic in the last class, contingently issuable shares. Okay. These are the examples of potential equity shares, like debt instruments or preference shares that are convertible into equity shares, convertible in the future. These are not compulsory convertible. These are not compulsory, optionally convertible, optionally convertible, optionally convertible. Because as far as compulsory convertible, we already understood that compulsory convertible are a part of your basic earning per share working. So please remember, these are optionally convertible equity shares, not compulsory. Compulsory convertible equity shares are actually taken into consideration while calculating basic earning per share. Share warrant. Share warrant means what? Share warrant is just an instrument where the company has already taken the money from the public, and the public is entitled that in future the company may provide shares against this share warrant. Okay. Options including employee stock option plan, ESOP, employee stock option plan, under which employees of the enterprise are entitled to receive equity share as a part of their remuneration. Under ESOP, employees may get equity shares in the future. May or may not get the shares. Shares that would be issued upon the satisfaction of conditions resulting from contractual arrangements such as purchase of business or other assets. Contingently issuable shares. Shares that may be issued upon the satisfaction of conditions. That would be issued upon the satisfaction of conditions. That means contingently issuable shares. If in the future the condition will be satisfied, I will give you shares. Contingently issuable shares. Share application money pending allotment if used in the business. Suppose if the company has received share application money but has not yet issued the shares, or has not yet allotted, has not yet made the allotment. So such share application money, and if it is used in the business, will be treated as potential, because in the future it will be converted into share. Although by act or by law, it is not allowed to use the share application money in the business until and unless you are making share allotment. So before making share allotment, you are not allowed to use the share application money in the business. So it says share application money if used in the business. If not used in the business, then they are not potential equity shares. The last one, partly paid equity shares to the extent of unpaid amount, not entitled for dividend. If there are some partly paid equity shares who are not entitled for dividend, they will be called as potential, because when in the future, if they become fully paid, they will be entitled for earning. So they will be treated as good as equity shareholders. Currently, they are not treated as good as equity shares because they are not entitled for dividends, since they are partly paid. So these all are the examples of potential equity shares. Guys, you must learn all these examples. You must know all these items of potential equity shares. A final student, a CA final student, should know about all these examples of potential equity shares. Okay. For the purpose of calculating diluted earning per share, the net profit or loss for the period attributable to shareholders and the weighted average number of shares outstanding during the period should be adjusted for the effect of all dilutive potential shares. Now, the formula will be, the formula for DEPS will be earnings attributable to equity shareholders plus earnings due to potential equity shares divided by weighted average outstanding equity shares and potential equity shares. The revised formula will be earnings attributable to equity shareholders plus earnings due to potential equity shares. ठीक है? This will be the DEPS formula. Now please do not read this paragraph. I will discuss it later on. Do not read this paragraph. Do not read this page. I will discuss it later on. I will discuss it later on. Let's talk about some examples. Let me check. Do we have some examples already available? Yes, we have, but we will not refer this right now. Okay. Okay, let's start discussing example number 1 on DEPS. Our EBIT was 12 lakhs. The tax rate is 30%. %, outstanding convertible debentures, 9% outstanding convertible debentures of rupees 15 lakh. Conversion into conversion into 40,000 equity shares after 2 years. Equity shares outstanding equity shares outstanding 1 lakh numbers. Equity shares outstanding 1 lakh numbers. Calculate BEPS and DEPS. Calculate basic earning per share and diluted earning per share. First of all, BEPS. For BEPS, we need two things, numerator and denominator. First of all, EBIT 12 lakh minus interest 1,35,000 minus tax 745,500. 745,500. So this is earnings attributable to equity shareholders. Now, denominator is weighted average outstanding numbers. 1 lakh. So basic earning per share will be 745,500 divided by 1 lakh. 7.455. 7.455. This is your basic earning per share. Now what about diluted earning per share? We will calculate diluted earning per share because we have potential equity shares, convertible debentures. So we will write here, we have potential equity shares, that is debentures, convertible. Right, now what was the formula? Formula was earning available for equity shareholders, that means 745,500 plus what would be the impact suppose the debentures got converted in the current year only. Suppose the same debentures from 1/4 the same debentures were not actually debentures, they have been converted into equity. What will be the impact? Tell me. I am just saying, I am asking that on 1/4 there were outstanding debentures and these were outstanding for the entire year. They are actually going to be converted in the after 2 years. But I am just asking that suppose in the same year if the debentures got converted on the same date, on 1st April, if the debentures got converted into equity shares, what would happen? Tell me. My earning will be increased. How? Can you please tell me how my earning will be increased? How my earning will be increased? The interest actually paid to them. The interest actually paid to them would have been saved. The interest actually paid to them, if the debentures would have been converted into equity from the very first day, the interest would be saved. I don't need to pay the interest amount. So my earning would be increased by the amount of interest. But of course, when my interest will be saved, the tax will be levied on this. So it will be saved to the extent of 70% only, because 30% tax would have been paid after saving. So what will be the total earning? It is 840. So the earning will be increased by the 70% of interest. The rest 30% I would have to pay by way of tax. Okay. If you don't believe this, then see this. Suppose this was 0. The tax would be, this is 12 lakh. The tax would be 3.6. So 12 minus 3.6, it would be 8.4. It would be 8.4. Now one is 8.4. Now, how to calculate weighted average outstanding? Weighted average outstanding. As far as on 1st April, equity shares are concerned, 1 lakh into 12 by 12. Same as on 1st April, potential equity shares. Potential equity shares. How much potential equity shares are there? How much potential equity shares are there? Can you see this? How much potential equity shares are there? How much potential equity shares are there? There are 40,000 potential equity shares. There are 40,000 potential equity shares. So 40,000 potential equity shares into 12 by 12. Why 12 by 12? Because they are outstanding from very beginning. So technically these are 140. Now calculate the diluted earning per share. Diluted earning per share would be 840 divided by 140. It's 6. See this. The basic earning per share was 7.455 and the diluted earning per share becomes 6. So it is reduced. Whenever your basic earning per share is reduced, it is called dilution. But whenever your basic earning per share gets increased because of potential, it is anti-dilution. Here it is a dilution. Why dilution? Dilution because of convertible debentures, because of potential equity shares. Guys, understood? Shall I give you another example? Example 2. Take same example 1. Take same example 1. But instead of 1/4, convertible debentures were issued. Convertible debentures were issued on 1st August. Please solve the question. Please solve the question. Okay, tell me the answer. Tell me the answer. As far as BEPS is concerned, first of all 12 lakh minus interest of 90,000 minus tax of 30%. So it is your EAESH. The weighted average numbers are 1 lakh. The weighted average numbers are 1 lakh. Basic earning per share would be 7.77. What about diluted earning per share? What about diluted earning per share? What about diluted earning per share? Diluted earning per share okay, sorry, connection is lost. Okay, now diluted earning per share. Diluted earning per share. Triple 7,000 plus this 90,000, 70% of 90,000. It should be 840 again. It should be 840 again. 1 lakh into 12 by 12, 40,000 into 8 by 12. 40,000 into 8 by 12. Why 8 by 12, sir? Because the debentures were issued on 1st August. August, September, October, November, December, January, February, March. So the debentures were issued on 1st August. So it should be The potential equity shares were outstanding from 1st August. So the DEPS will be DEPS will be 6.63 per share. Earlier the BEPS was 7.77, now the DEPS will be 6.63 diluted portion. This was example number 2. 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 Okay. Now, there is one more example. Example number 3. There is one more example. Example number 3. Example number 3. There is one more example. Example number 3. Take same example 1 with following additional info. With following additional info. On 1st July, entity issued 12% preference share capital. 12% preference share capital. 12% preference share capital of 50,000 numbers, face value 100. These are convertible. Convertible after 5 years in the ratio of convertible after 5 years in the ratio of 3:2. In the ratio of 3:2. Okay. Okay. Now, now how to solve the question when we have two different potential equity shares? See, write this. In this question, we have more than one potential equity shares. We have more than one potential equity shares. Convertible debt instrument, convertible preferential capital. We have more than one potential equity shares. When we have more than one potential equity shares, now the working will be quite changed. We need to work on the additional points. Like first step, step number 1. Calculate incremental EPS for each potential equity separately. What is this incremental EPS? Please see this. As far as convertible debt instrument is concerned, from same example number 1, convertible debt instrument was outstanding from very beginning of the year at 9%, and the interest portion on convertible debt instrument was 135. If this potential equity would have been converted, we will have a saving of 135 into 70%, that is we will be having a saving of 94,500. We will be having a saving of 94,500, right? Like saving due to conversion divided by weighted average potential equity numbers. Now what is saving due to conversion? 94,500 divided by weighted average potential. In the example number 1, this was 40,000 and from very inception 14. So 40,000 into 12 by 12. So 94,500 divided by 40,000, it's 2.3625. What is this? This is incremental EPS. Incremental EPS means taking each potential equity separately, taking the effect of each, calculating the effect of each and every potential equity separately. Now, we will take convertible preference. Now, same, because of convertible preference, suppose these preference shares would have been converted in the same year. What will be the saving due to conversion? Can you guys tell me the saving? Can you guys tell me the saving? Can you guys tell me the saving? What will be the saving? See, 50,000 numbers are there. 50,000 into 100, that means 50 lakh into 12%, that is 6 lakh. 6 lakh into, they were issued on 1st of July. They were issued on 1st of July. So 9 by 12. So it's 450. The saving will be 450. And please remember one thing. The dividend is not tax deductible. The dividend is not tax deductible. There will be no tax effect on preference dividend because dividend is not tax deductible. So it will be 450. That is 9 months saving. That is 9 months saving. 450. Divided by weighted average potential. Weighted average potential is, if they are going to be converted into equity, the ratio is 3:2. The ratio is 3:2. So the number of shares will be 50 into 3 divided by 2. 75,000 into 9 by 12. Why we have taken 9 by 12? Because they were issued on 1st of July. Even the numerator belongs to 9 months. The denominator should also belong to 9 months. $56 to 50. That is 8. So these are the incremental earnings per share. These are the incremental earnings per share. When we have more than one potential equity, when we have more than one potential equity, we first of all calculate incremental EPS. Okay. Now, out of these two, which one is more powerful? When I am asking powerful, I mean to say that which one is going to impact, which one is will going to affect our existing basic earning per share drastically. Out of these two, which one individually only, out of these two, which one is going to affect our basic earning per share drastically? Which one will more affect? Which one will affect more? Out of these two, which one will affect more? Out of these two, which one will affect more to our basic earning per share? Tell me. Out of these two, which one will affect more to our basic earning per share? Which one will affect more? Out of these two, which one will affect more? You guys are saying preference share. You guys are saying preference share. Okay, let's check. It's just a rough working. Please do not write this. Let's check. Which one will affect more? Let's check it out. Numerator, denominator, EPS. So our numerator is in example number 1, our EISH was 745,500. Our denominator was 1 lakh. So EPS was 7.455. Okay, it was a basic earning per share. Now, which one will affect more? Okay, let's check. First of all, take the effect of convertible debt only. Convertible debt 94,500 and 40,000. It's 840. It's 140. It is 6. Right? Our basic earning per share was affected. Our basic earning per share was affected. Okay. Now remember this. Our basic earning per share was affected. Our basic earning per share was reduced. Our basic earning per share was reduced. Okay, but instead of convertible debt, if we take convertible preferential capital, what would be the effect? If we take convertible preferential, what will be the effect? Like our earning will be 450. Our earning will be 450, increase by 450. And the number of shares will be 56,250. It is 1195 500. It is 156 250. It is 156 250. Now please calculate. Tell me the answer. Tell me the answer. This working is just to prove something, that which one is affecting our basic earning per share drastically. Which one is affecting more? Which one is affecting more? This working is just to prove that you guys, your answer of preferential was wrong. Your answer of preferential, that you were saying that preferential is affecting more, you were wrong. This was just to prove you that the preferential is not at all affecting our basic earning per share. Even it is increasing. Even it is increasing. Please calculate, na? Please calculate. We just have taken the individual effect of convertible debt and individual effect of convertible preference. So which one is affecting more? 7.65. Oh my God, it is increasing the basic earning per share. So it is anti-dilutive. It is anti-dilutive. Now got that point. So tell me, what will be the answer? Which one will be the more effective potential equity? Which one out of these two, which one is affecting more? Which one is affecting more? Tell me. Tell me, which one is affecting more? Which one is affecting more? The one with lower value. The one with lower value. So we call it, we give it a rank 1 and we give it a rank 2. Now got that point? Now got that point? So the one with lower value or the lowest value will be more affecting our basic earning per share. Rank 1 and rank 2. Now what we will do? What we will do? Now what we will do? Now step number 2 would be calculate diluted earnings per share. Calculate diluted earning per share. Particulars, numerator, denominator, earning per share. First of all, basic. Numerator was 745 500. Denominator was 1 lakh. Our basic earning per share was 7.455. Plus, now, rank 1. We will take rank 1 item. Rank 1 item was convertible debt. 94 500 and 40. it becomes 6. Now rank 2, convertible preferential capital, 450 and 56,250. $196,250. It becomes 6.57. So please see this. Our basic earning per share was reduced first of all to 6. Then it increased. That means our final answer should be this, diluted earning per share, because this is a dilutive potential equity and this is not dilutive. This is not dilutive potential equity. Even it is an anti-dilutive because it increases the effect. So our answer will be 6, basically diluted earning per share. Have you understood the point? So out of these two, one is dilutive and the another one is anti-dilutive. In case of anti-dilutive, we ignore this effect. Guys, understood or not? Understood or not? So this is the final working of diluted earning per share. You can write this. I have to conclude this session for the time being. Your homework is to read this part, the dilutive and anti-dilutive. Read this part, this entire part, even this table also. Okay? This table also. Then you can try illustration number 15. You can try illustration number 15 and illustration number 16. You can try illustration number 15 and illustration number 16. So you can try these two illustrations. Okay. How was it? Please tell me your experience about diluted earning per share, like example number 3. How was it? Okay, loved it, interesting. Thank you so much guys, interesting. Thank you so much guys. Let's conclude the session. Today's session will be uploaded in the evening. Now we will upload every session every day. Now we will upload every day because now we have a 3 or more than 3 hours of class in a day. So we will upload the sessions every day. Okay. So guys, thank you so much. Bye bye. Take care. Jai Mata Di. Allah Hafiz.